So in part one for chapter 5 on national income accounting, we basically defined what gross domestic product is. We were very specific in terms of the definition so that we know exactly what is included in GDP versus what is not included in GDP. Now what we're going to do in part 2 is use our formulas to figure out how to calculate the value of GDP. And there's three basic methods. You can use the expenditures approach, the income approach, or the output approach. Theoretically, all three should give you the same exact answer. The one that we predominantly are going to be using in this class is the expenditures approach. In other words, the total value of money that is spent on goods and services that are produced. But we want to make sure that we understand what the income approach is and what the output approach is also. So I will cover those first briefly and then go into the expenditures approach for calculating gross domestic product. Now, if we were going to use the output approach to calculating GDP, basically we would just be adding up the value of all of the goods and services that were produced, within the United States for that year. And so this is the data that we have for 2010. Now, of course, remember that we divide the output into 4 different categories. You can have output produced by businesses, you can have output produced by foreign businesses within the United States, and then of course you can have output that is produced by households, and lastly output that is produced by the government. And so when we look at the data for 2010, it should come as no surprise that in a capitalist country like the United States, the majority of the goods and services are produced by the businesses. So again, you see right here, 3/4 of the goods and services that are produced in the United States are produced by the businesses, the U.S.-owned businesses and the foreign businesses that are within the borders of the United States. And then the other quarter of output basically is divided, roughly equal between the households and the government. So households produce about 12.5% of the output, and the government produces about 12.5% of the output. So that's all you would do if you were looking at the output approach, is what is the value of the goods and services that are produced by the different sectors within the economy. Again, the more private your economy is, or the term we generally use is capitalist, the more capitalist your society is, the more output that is going to be produced by the businesses. Whereas if you have an economy that is more centrally planned, you're going to see more output produced by the government. Now, the second approach to calculating GDP would be using the income approach. So in other words, you would be adding up the total value of income that was generated from the production of the goods and services. In other words, we know that the firms, in order to produce that output, they use resources, and you have to pay those resources income. So theoretically, the income that is generated should equal the value of the output that is produced. So you pay for your land, labor, and capital, and then of course whatever's left over is going to be your profit, and so you add that all up. Now, in addition to the income that is generated by the resources in terms of land, labor, capital, and profits, we also would have to include non-income expenses in order to ensure that the value of the output is equal to the value of the income, depending on which approach you use. And so some non-income expense accounts would be what we call indirect business taxes and the capital consumption allowance. So let me define what those are. All right, so by definition, an indirect business tax is just going to be a tax that is collected by businesses for a government agency. So let's say, for example, that you stayed in a hotel and the room rate was $100 a night. However, they collected $110 from you because of the tax on the room. Obviously that hotel would not keep that $10 in tax. They would forward that on to the government. So that is an example of an indirect business tax, where the business actually collects the tax from the consumer, but then they forward it to the government. So some examples of indirect business taxes would be, again, like my example of the hotel tax, so an excise tax, or like a sales tax. Those would have to be included in GDP using the income approach to ensure that the income approach is going to equal the amount of expenditures. And then we also have to include what we call the capital consumption allowance. This would be also referred to as depreciation, and this is the value of money that businesses spend to replace worn out or depreciated goods. So we would have to include whatever the value of that capital consumption allowance is also when we are computing GDP as income. And I'll go into more specifics in terms of the definition of what is something that would be included in the capital consumption allowance when we go over GDP as expenditures in a moment. But again, when we're calculating GDP as income, not only do we use our income accounts, but we also include indirect business taxes, the value of the depreciation account, and then we also have a small amount in terms of the net factor income from abroad, which is usually less than 1%, but we have to include that also. Now, the actual income should feel familiar to you because we covered, this back in chapter 1. In other words, we know that households allow the firms to use our resources because they generate income for ourselves. So we said that if you are an owner of labor, you will receive wages. So we include that in GDP as income, and that is the largest category of income that is generated. More than 50% of all the income generated in the United States comes from wages alone. And then, of course, if you are an owner of capital, you receive interest. So we have to include any income that is obtained through the ownership of capital in the interest account. We also learned that if you are a landowner, you receive income in the form of rent. You'll notice that we also have royalties from copyrights and patents that are also included in this category. And then, of course, after the firms have paid for their wages, interest, and rent, whatever is left over is going to be their profit margin. So whether we're talking about a sole proprietor, whether we're talking about a corporation, we know that after they paid for their resources, whatever's left over is going to be their profits. And so then that is the income of the business. So these are our primary categories that we use to calculate the total value of income that is generated, from using the income approach for GDP. What I've done right here is made a pie chart for you just to kind of hammer home and give you an idea of, which resources or, which categories of income actually generate the most income in the United States. And so this was for the third quarter of 2010. And again, what we see is that the predominant resource that generates the most income would be labor. 55% of income in the United States comes from wages alone. And then profits come next. In other words, notice that if you add up the corporate profits and the proprietor's profits, that's about 16% of income generated in the United States come from business profit margins. Next would be interest, so those that own capital, 6% of income generated from the interest account. Landowners account for about 2% of income generated in the United States. And then, of course, our other categories, the capital consumption allowance and the indirect business taxes, that's 20% right there. All right, now our last approach to calculating GDP would be what we call the expenditures approach. And this is the most common approach, and this is the approach we're going to be using throughout the rest of this course. So you're going to get very, very familiar with the formula that we use to calculate GDP in terms of expenditures. And so this is just where we add up the dollar value at the current market prices of all the final goods and services that are sold. In other words, how much are consumers spending on the goods and services that are being produced and sold within the United States. So in order to calculate GDP as expenditures, we need to know, well, who's purchasing the goods and services? So again, we look at the same categories that we've already been using. We know that we divide the economy into different sectors. You have the household sector, the businesses, the government, and then of course the international businesses. And you would just add up the total value that each different sector is spending to calculate gross domestic product as expenditures. So households, we know that they do spending, and we learn that when they spend, we denote that by the letter C. We call those the consumption expenditures that take place. We know businesses spend money, and when we refer to business spending, we call that investment expenditures. So in our formula, we refer to that as the letter I. The government also spends money within the economy, and we will use the letter G to denote the amount of money that they spend. And then, of course, in order to calculate the value of expenditures from the international sector, we would just use our net exports function. So we would take the total amount or the total value of the goods that we export to other countries and subtract out the value of the goods that we import. And we'll use the letter X to denote the value of the net exports. So we would add all of these up, in other words, the expenditures by the different sectors within the economy, and that would give us the value of GDP using the expenditures approach. So let's look at the expenditures by each individual sector individually. Now, in terms of the money that households spend, I've already stated in previous lectures that consumption constitutes the largest amount of expenditures that take place in the economy every year. Households alone spend about 70% of all of the money being spent on goods and services in the economy. So this is the largest expenditure using the, when we're calculating GDP using the expenditures approach. And when we look and see how consumers can spend their money, we basically can just divide it into three basic categories. They're either spending their money on durable goods, non-durable goods, or services. And I just give you a few examples right there on the lecture slide of what constitutes, each different category. But again, the most important thing to remember when we're talking about consumption expenditures is the fact that it does constitute the largest percentage of expenditures being, every single year from, households alone. Now, the second category of expenditures would be the money that is spent by businesses. In other words, we know that even though businesses are the ones that are predominantly producing the goods and services, they need to spend money in the production process. So any money that businesses are spending on capital goods to produce the final goods and services, we define that as an investment expenditure. And currently, investment expenditures are the third largest category of expenditures in the United States. So first, households spend the most, then actually the government is currently outspending businesses, and then the third category would be investment expenditures. I think it currently constitutes about 16% of total expenditures in the United States. Now, we can actually distinguish between two different investment categories. We can be looking at net investment, or we can be looking at what's called gross investment. And whenever we're talking about the investment expenditures using the GDP approach, we're always referring to gross investment. And the way that we calculate gross investment, if it's not already given to you, is you would take the value of the net investment and add in what we call the capital consumption allowance. So again, the capital consumption allowance, also referred to as the depreciation account, is the money that businesses spend to just replace or repair worn out or depreciated goods. So you're not actually adding to the overall capital. You're just replacing. So just to give you an idea, let me give you an example. So again, for example, let's say that the total value of net investment was $100. So in other words, firms spent $100 in order to, produce capital goods and services that were used in the production process. However, in that same year, they estimated that the value of their capital goods that depreciated, so in other words, the capital consumption allowance was $40. In other words, they had $40 of depreciation taking place for the capital goods that they use in the production process. Therefore, the value of the gross investment, or the amount that we would include in GDP for calculating GDP as expenditures, would actually be $140. We would add up the net investment, the actual amount of expenditures that were taking place, plus we would add up the estimated value of depreciation, in other words, the value of the capital consumption allowance, and then that's what we would include in GDP. So whenever we're talking about GDP as expenditures, and specifically the investment expenditures that are taking place, we're always using gross investment, not net investment. So if you were doing this in a problem and I didn't give you the value of gross investment, you would just have to find the value of the depreciation, the capital consumption allowance, and add that to the net investment. The third sector in the economy that spends money is the government, and we know currently the government is the second largest spender in the economy. They're currently outspending the businesses, and the government can spend money in two different ways. They can simply buy goods and services from the private sector, so that's easy to understand. Or we also have to include the money that they use to pay the wages of the government workers or employees in terms of their spending also. Now, we want to make sure that we distinguish. In other words, if you work for the government and they pay you a salary, then that is included in GDP. That's considered a government expenditure. So again, a salary would be included. But let's say the government makes a payment to somebody in the form of Social Security. In other words, let's say you retire, you've reached the age where you can collect Social Security. That is not included because that is just a transfer payment. In other words, they're just taking the tax dollars, the income that was generated by one group of people, collecting it and then transferring it to another group of people that did not earn it. So something like Social Security is not included. That's not considered a government expenditure in terms of GDP. However, a salary paid to a government worker is. And then the last sector that we include in GDP as expenditures would obviously be including the international sector. And the way that we measure that is through the value of our net exports. So we take the total value of goods that other countries buy from us, which is our exports, and then we subtract out the total value of goods that we purchase from other countries, and that would be our imports. And so, of course, we just look at what we call our net exports, and that will tell us what impact the international sector is having on our economy in terms of expenditures. And of course, because our net exports are constantly negative, that means that it causes the value of our GDP to decline because we are adding a negative value when we're doing the C plus I plus G plus X. When we're adding that X value, it is actually negative, so it causes our total GDP to go down. So now we can put this all together to see again how we would calculate GDP as expenditures. Again, GDP as expenditures is just C plus I plus G plus X. We just add up the expenditures by each individual sector of the economy. So if we were looking at the data for 2012, we can look to see, well, in 2012, households spent approximately $15.7 trillion. Then we would look to see, well, how much did businesses spend? Businesses in 2012 spent approximately about if we round, about $2.1 trillion. If we look at how much the government spent, in 2012, the government spent about $3.1 trillion. And then, of course, we have to look at our net exports. In other words, the difference between what the value that we exported versus the value that we imported. And so that actually has a negative value. That's about 0.57 trillion, or $570 billion. And so we just add all of that up, and we would come up with a total GDP of approximately 15.7 trillion dollars in 2012. So that would be the total value of goods and services that were purchased using the expenditures approach. And remember, it doesn't matter if we use the expenditures approach, if we use the output approach, if we use the income approach, we would be basically coming up with the same value no matter what. It's just that this is the formula that we generally use the most. In other words, GDP as expenditures, consumption spending plus investment expenditures plus government expenditures plus the value of the net exports. You add that all up, and that is what gives us the value of GDP. And now I'm looking at my data and I'm seeing why things were not adding up. When I was putting down the household expenditures, I actually was putting in the GDP, so forgive me for that. The total value of the household expenditures was actually 11.1, 11.2, somewhere around there in terms of their expenditure. So again, if you add up the numbers now, you'll come up with roughly $15.6, $15.7 trillion of expenditures for 2012. Now, GDP is not the only national income accounting technique, but it is the most common. But there are other forms of measuring output and income in the United States. These are the 5 most common. So you can calculate what's called gross national product. You can calculate net national product, national income, personal income, and disposable personal income. However, I'm not going to go into detail in those formulas in the lecture slides, because GDP is what we are going to be using the most. So it's going to be your responsibility to cover those 5 national income accounting techniques in your reading assignment this week.